Thank you, Rungu, and a very good morning to everybody. When I use the word transformation, ladies and gentlemen, what comes to mind? So when I think about transformation, when I reflected about today's topic, I was reminded of one of the most majestic symbols of Africa, the baobab tree. So the baobab is not just a tree, it's a legend. It's a prehistoric species that's been around for not 100, but 200 million years, right? It grows in 32 African countries, and where the land is dry and arid, where little else can thrive, the baobab stands tall, truly tall. During the rainy season, it absorbs and stores water in its vast trunk. And then in the long dry months, it produces nutrient-rich fruit, sustaining life when everything else fades. And that's why across the continent, it's called the tree of life. It's a symbol of endurance, of resilience, and quiet strength. It provides shelter, food, and water for both humans and animals. And many communities have built their homes around and near baobab trees because they represent stability and they represent renewal. So you may also recognize the baobab from stories we've all grown up with. The Lion King, it's there, Rafiki's tree in the Avatar, if you guys remember, the tree of soul, the tree of souls. Even it's in The Little Prince, La Petite France, they bring it out there. It's a global icon. And you may very well ask me this morning, what does the baobab tree have to do with real estate? Like truly, what does it have to do with real estate? So as I reflected on this morning's events, it made me realize that the baobab tree reflects, quite symbolically, it symbolizes the transformation that we are witnessing in Kenya's real estate industry and within the capital markets today. So for years, and I'm sure many of you are aware, we've been at the real estate at RAC and at KPDA and at the NSC, at the CMA, at the RBA. We've been growing roots, very deep roots. The regulatory framework, the governance standards, the market infrastructure. Much of that work has happened below the surface, right? It's been quiet, it's been unseen, it's been patient. But now with the REIT Toolkit and Incubator Program, those deep roots are beginning to bear fruit, very much like the baobab fruit. And so like the baobab, the REIT market is transforming today, not suddenly, but quite sustainably. It is learning to thrive in a challenging climate. It stores capital in good seasons and distributes value in lean seasons. It's rooted, it is resilient, and if nurtured, it can become one of the great trees of life for the Kenyan economy. So allow me to speak for a little bit for the fund management industry. Why REITs matters to someone like myself? Why would it matter to the Fund Managers Association? I can see we've got the logo there. And we represent about 2.3 trillion shillings worth of assets under management. Because we as fund managers, we sit in a rather unique place on the risk-return spectrum, right between what you call fixed income, govies, government securities, I think Irungu just mentioned that, and equities. You've all seen a buoyant mood in the equity market recently. So literally, REITs combine the best of both worlds, the fixed income side and the equity side. And why? Because, and I think Zorav has referred to it, they're consistent, tax-efficient cash yields. There's capital appreciation through asset growth and cap rate compression, which many of you talk about. And there's also inflation protection, since rents and property values rise with inflation. So if bonds give us income and equities give us growth, what do REITs give us? Both. Income and growth. They are Kenya shilling denominated, and I'm sure at some point we will see USD REITs coming into the market. They're relatively low volatility investments that provide real asset exposure without currency risk. They offer stable income streams, often within the 10 to 12% range, whilst contributing all along to domestic development and employment. And as inflation and market volatility continues to reshape the global asset allocation, which we look at very critically as fund managers, this kind of stability is anchored in structures becomes increasingly valuable to us. So as a fund manager, what I will tell you, the key thing that we look at is asset allocation. And if you can get your asset allocation right in your entire portfolio, you've hit pay dirt. That's gold. And REITs provide such an incredibly good part of asset allocation. Now, let me address the characteristics of REITs that we as fund managers find appealing. REITs are institutionally designed, so they mirror what we as fund managers already value, right? As a fund manager. Governance, that's critical, guys. Governance, transparency, liquidity, that's one question we will always ask. If we're going to get in, can we get out? So they provide liquidity and, most importantly, discipline, right? Exchange traded liquidity. Let me go through the points. Units can be traded on the NSE. I think Irungu has referred to that, allowing flexibility that direct property lacks. I think some of you in pension funds may have gotten into property, cannot get out right now. A REIT can allow you that with the liquidity. Professional management. Licensed REIT managers and trustees ensure active oversight and compliance. Transparency and governance. I need not highlight this more. Regular reporting, external audits, independent property valuations. So that transparency and governance bit, it's all important. You cannot get this past a trustee or an IC, an investment committee meeting, if there is no governance. Institutional grade assets. High quality real estate portfolios provide steady income. So that's why the sort of buildings that we're looking at ought to be at an institutional grade level. And finally, the economies of scale. Centralized management reduces operating costs, and it indeed enhances performance. So in short, ladies and gentlemen, REITs allow access to property exposure without illiquidity, without concentration risk, or the management burden of direct real estate asset ownership. It's a professional evolution of how we as investors can participate in the property market. Allow me to now just go through a fund manager's perspective, and I'll reiterate what I've just said. So there are 6 key considerations that we would look at when assessing REITs. The first one, which I've already addressed, is liquidity. Trading volumes are still developing. If you look at it currently, it's not that great, but it is developing. So with initiatives like the REIT Incubator, potential liquidity, windows, depth will grow. So for now, we should focus on total return versus medium-term returns, or rather than short-term trading. Governance and transparency, I think I've already talked about that. Let me insist on this: high quality yield. High quality yield versus risk. A well-structured REIT should offer at least 2 to 3% premium over and above a 10-year government bond to justify the liquidity and property exposure risks. So remember, when we're looking at a portfolio, as a fund manager, we would ask, guys, I can take my money, I can park it in a government security, in a govie. It's risk-free, right? I can go to sleep comfortably. If I have to invest in a REIT, there must be an added compensation for that. And that's why we insist on the yield. And it's important, REITs provide the high quality yield. Valuations, watch the relationship between the market price and the NAV, right? A discount may reflect illiquidity or sentiment. A premium will signal confidence into the market. The portfolio fit. REITs sit comfortably, as I mentioned earlier, between the fixed income side and the equity side. So it's really ideal for a growth mandate. And finally, the regulatory fit. The CMA rules already provide allocations from pension funds and CIS. CIS is collective investment schemes into REITs. So what's missing? So the regulation is already there. What's missing from our side is conviction and product scale. So our task as fund managers is to bring that conviction, right? To apply our analytical discipline, to measure risk and reward, and to recognize REITs as a core income asset in the Kenyan portfolio of the future. And of course, the only way to do it is through capacity building, as we're doing right now. This morning, as I was getting my remarks ready, I came across a quote, and it said, "You must either modify your dreams or magnify your skills." Modify your dreams or magnify your skills. So ladies and gentlemen, I'll put it to you that we've come too far to modify our dreams, right? We've come too far. Let's begin and continue with the trainings. Let's magnify our skills as an industry. I always like to look at comparables within the market. And for me, the best comparable would be to look at South Africa. I don't know if any one of you is aware of this, but REITs in South Africa started the same year as it started in Kenya, in the year 2013. That's literally 12 years ago. But if you look to South Africa, you'll see a more mature REIT ecosystem and what a mature REIT ecosystem can do. In that time, in 12 years, remember we started at the same time, SA has seen over 35 listed REITs with a combined market cap of over 300 billion rand. If you multiply that by 7, what do you get? 2.1, a little over 2 trillion KES, right? Kenya shillings. The yields are around 8 to 10% sustainable yields. There's a gearing cap below 40%, right? There's a diversification across all sectors, retail, logistics, healthcare, residential, office. And there's also offshore exposure in currency and geography diversification. So they have done it. I don't see why we can't. The foundation of that market is predictable income, strong governance, and I keep saying this, liquidity for us fund managers. So in my opinion, ladies and gentlemen, the lesson for Kenya is clear. If we build transparency, if we build liquidity and predictable income, the income will follow. The broader impact of REITs. REITs don't just transform portfolios, they transform places. They create jobs, they drive urban development, and they support sustainability, right? So every shilling that you contribute into a REIT, there is not just a financial return, but there's an economic return. Yesterday morning, I went to the gym quite early, and the sun's just coming up. I live in Kileleshwa, Kilimani, it's on the border, I think. I can never tell. So I'm running on the treadmill, and I'm looking, in my line of sight, I started counting the number of buildings. Just running on this treadmill for 10 minutes, and I guess I was bored, and I counted over 20 buildings that I think were over 20 floors. 20 plus buildings in just my line of sight. Tells you something, right? It's our role, it's our job, it's our responsibility. We're seeing this transformation out there. I think it's our role to bring that transformation into the capital markets. And as fund managers, that is something we can participate in. So allow me to close by coming back to the baobab tree, right? For centuries, it has stood as a silent witness to Africa's resilience, adapting, enduring, and giving life. So it reminds us that true transformation doesn't happen overnight. It happens through deep roots, strong culture, and time, the hand of time. The REIT Toolkit and Incubator Program that we're launching today represents that same kind of transformation that we want. The deep roots that will sustain growth for decades to come. And we as fund managers, as investment bankers, there are a few in the room here, trustees and developers, if we nurture this ecosystem with discipline and purpose, REITs can become our financial baobabs, resilient through seasons, storing value in the good times, and sustaining life in the challenging ones. And just like the tree of life, ladies and gentlemen, they will provide shade, they will provide nourishment, and they will provide stability, not just for our portfolios, but indeed for the entire economy. Thank you.
One round of applause to Mr. Ewart Salins. Thank you very much. Yeah, so we've been reminded about the baobab tree.